The FDIC, Federal Deposit Insurance Corporation, is an independent agency of the United States government that protects bank depositors against the loss of their insured deposits in the event that an FDIC-insured bank or savings association fails. FDIC insurance is backed by the full faith and credit of the United States government. So in this video, we are going to discuss how much does FDIC cover if a bank fails? Now before we get into this video, make sure to hit that subscribe button and leave a comment below saying I subscribed. I will try my best to reply to as many comments as possible. The FDIC was created in 1933 to provide deposit insurance and maintain stability in the U.S. banking system. It is an independent agency of the federal government that guarantees deposits up to a certain amount in case a bank fails. Currently, the FDIC covers deposits up to $250,000 per depositor per insured bank. This means that if you have accounts at different banks, each account is insured up to $250,000. However, if you have multiple accounts at the same bank, the total coverage is still $250,000. It's important to note that not all deposits are covered by the FDIC. The FDIC covers deposits in checking accounts, savings accounts, money market accounts, and certificates of deposit, CDs. However, it does not cover other financial products like stocks, bonds, mutual funds, or annuities. The FDIC insures deposits at FDIC-insured banks up to the maximum amount allowed by law. As of 2021, the standard maximum insurance amount is $250,000 per depositor per insured bank for each account ownership category. FDIC insurance covers all types of deposits, including checking accounts, savings accounts, money market accounts, and certificates of deposit, CDs. It does not cover investments such as stocks, bonds, or mutual funds, nor does it cover losses resulting from fraud or theft. In order for a bank to be FDIC insured, it must meet certain criteria and pay insurance premiums to the FDIC. Most banks in the United States are FDIC insured, but it is always a good idea to check with your bank to make sure. Deposit insurance is one of the significant benefits of having an account at an FDIC insured. What happens to your money when a bank closes down? That depends on whether the money is insured or not. In general, there's a good chance your bank is insured by the FDIC, according to Jim Pendergast, Senior Vice President at Altline by the Southern Bank. In theory, your money is safe, Pendergast says. But that's a bit like saying your house is safe during an inferno if you have fire coverage. It's not a stress-free process to go through. The main cause for worry during a bank failure would be if the total of your deposits exceeds the FDIC coverage limit. If the amount of your deposits is greater than what's covered, any additional amount isn't insured. Here's what happens in each case. Insured. If your deposits at the institution are under the FDIC insurance coverage limit, you can expect full reimbursement with money paid from regulatory funding. Not insured. For amounts above the coverage limit, things are a little dicier, according to Meyer. If bank ownership is transferred to a healthier bank, there's a good chance that nothing will be lost. However, if it isn't, you might have to file a claim for the excess funds. You'll only receive reimbursement if there is money left over after the assets are sold. The bottom line is if your money is kept with an FDIC-insured bank, you'll at least be guaranteed up to $250,000. So, even if you have more at the bank, you'll at least get reimbursed up to that limit. Then you can see about getting the remainder later on. The FDIC states that it aims to return your insurance money within 2 business days of the bank failing. The National Credit Union Association, NCUA, provides a similar service for credit unions. If your money is at a credit union, it is similarly protected by the NCUA with the same limits. This can provide peace of mind, no matter what type of institution you prefer for your money. It's important to note, however, that some banks and credit unions have accounts that aren't covered by FDIC or NCUA insurance. If you have a brokerage account through your bank, that money will be covered by the Securities Investor Protection Corporation, SIPC. The SIPC covers up to $500,000 of the securities in cash held in your brokerage account. Make sure to understand which accounts are covered by which type of insurance in the event of a failure so you know how much you're entitled to, as well as where the guarantee is coming from. What causes bank failures? The FDIC was created in 1933 in response to the bank failures of the Great Depression. Banks actually pay insurance premiums to receive this coverage, registered financial consultant Meyer explains, so no taxpayer funds are involved. Bank failures come about mainly because the institutions involved are unable to meet the obligations they have, which can be to depositors or other institutions. However, there are different triggers that can result in this inability to maintain solvency. If a bank assumes too much risk in its investments or loan portfolio and realizes its losses, that could be a cause of the failure, Meyer says. If no additional capital is raised and the losses are severe enough, the regulators will assume the institution to sell or liquidate it. The fact that banks fund their own insurance policies means that if the bank has taken on more risk than it can handle, taxpayers aren't on the hook for the losses. Basically, when you receive reimbursement for your money up to the limit, you don't have to worry about being paid back with your own money in the form of taxes. In many cases, though, as Altline's Pendergast points out, the whole process is smooth and you might not have any money at risk. If they find a bank to take over and things go according to plan, you may not even realize that the original bank failed, Pendergast says. All you'll know is that your checks and debit account still work fine. Then one day you'll be issued new debit cards. The FDIC is an important safeguard for depositors in the U.S. banking system. It provides insurance coverage up to $250,000 per depositor per insured bank for deposits in checking accounts, savings accounts, money market accounts, and CDs. However, it's important to note that not all financial products are covered, and that coverage is limited to FDIC-insured banks. First, as the insurer of the bank's deposits, the FDIC pays insurance to depositors up to the insurance limit. Historically, the FDIC pays insurance within a few days after a bank closing, usually the next business day, by either providing each depositor with a new account at another insured bank in an amount equal to the insured balance of their account at the failed bank, or issuing a check to each depositor for the insured balance of their account at the failed bank. Second, as the receiver of the failed bank, the FDIC assumes the task of selling or collecting the assets of the failed bank and settling its debts, including claims for deposits in excess of the insured limit. If a depositor has uninsured funds, funds above the insured limit, they may recover some portion of their uninsured funds from the proceeds from the sale of failed bank assets. However, it can take several years to sell off the assets of a failed bank. As assets are sold, depositors who had uninsured funds usually receive periodic payments on a pro rata cents on the dollar basis on their remaining claim. FDIC deposit insurance. Since 1933, the FDIC seal has symbolized the safety and security of our nation's financial institutions. FDIC deposit insurance enables consumers to confidently place their money at thousands of FDIC-insured banks across the country and is backed by the full faith and credit of the United States government. FDIC deposit insurance coverage depends on two things. First, whether your chosen financial product is a deposit product, and second, whether your bank is FDIC insured. Depositors do not need to apply for FDIC insurance. Coverage is automatic whenever a deposit account is opened at an FDIC-insured bank or financial institution. If you are interested in FDIC deposit insurance coverage, simply make sure you are placing your funds in a deposit product at the bank. Coverage limits. The standard insurance amount is $250,000 per depositor per insured bank for each account ownership category. The FDIC provides separate coverage for deposits held in different account ownership categories. Depositors may qualify for coverage over $250,000 if they have funds in different ownership categories and all FDIC requirements are met. All deposits that an account holder has in the same ownership category at the same bank are added together and insured up to the standard insurance amount. The FDIC acts in two capacities following a bank failure. Number one, as the insurer of the bank's deposits, the FDIC pays deposit insurance to the depositors up to the insurance limit. Number 2. As the receiver of the failed bank, the FDIC assumes the task of collecting and selling the assets of the failed bank and settling its debts, including claims for deposits in excess of the insured limit. Let us know your opinion in the comments section below. This was all for today. Hope you liked the video. Subscribe to our channel and stay tuned for more interesting videos. Stay safe, and we will be back soon with another video.